We have Don Luskin of Trend Macro, Joe Battipaglia of Stifel Nicholas, Vince Farrell, CNBC contributor. Don Luskin, market's gone down now every day. It seems like 150 points. There may be lots of reasons for this. What are you thinking here?
Well, I'll tell you, things must be really bad on Wall Street, because on a day when Elliott Spitzer gets in this kind of trouble, you'd think the Dow ought to be up 1,000 points to celebrate seeing that guy put away. This was what goes around comes around, and Wall Street ought to be celebrating.
Now, we haven't been put away yet, but
he's going to be, Larry.
Some people say traders were so distracted by the Spitzer thing that stopped them from selling. So maybe there is a silver lining.
Well, I think there actually is one little connection here, and that is that the governor of New York is the guy that the New York superintendent of insurance reports to, and that guy is right in the middle of handling this ongoing crisis of the bond insurers like AMBAC and MBIA. These guys are not out of the woods yet, and that regulator is very important. So if we have a governor who's distracted, or a lieutenant governor who suddenly becomes governor and is distracted by all of his new duties, we could have an administration that's asleep at the switch on a real crisis.
Now, Farrell's given what I think is a contrary view. A Fed funds rate emergency cut tomorrow or the next day, bearish for stocks or bullish?
Well, I think the Fed's been cutting rates too much all along, so I'm against it. However, there's an important caveat. The market expects the Fed to cut rates by another 125 basis points, and the market knows that the Fed is a slave to expectations. So given that, the Fed might as well just do it. Why wait for the meeting? Just get it over with.
Luskin, where do you go from here? Where do you go? Commodities may be in a corrective mode. I know you pushed that theme and that stock inflationary theme. I got to go kind of fast, but where do you go? What are you doing now?
I think you've got to play the inflation theme. That's the one thing that you know for sure is going to work. Nothing is going to stop the Fed from bowing to market expectations and keep cutting and cutting and cutting. Now, you said earlier that negative real interest rates are a bad sign for growth. The Fed doesn't see it that way. They think that if they can create negative real rates, that'll basically be a helicopter drop of money for the whole economy, and that'll be the bottom. That'll stimulate growth. That's what they're trying to do. It's a classic Keynesian formulation. Low real rates have been associated with economic bottoms. They might be right, but that's the strategy. But that means inflation, inflation, inflation.
The dollar and inflation are the 9th and 11th Fed priorities right now. Joe B., what's your